This is Mastering Your Wealth with David Gagnon, the podcast.
Now that the election is over and Donald Trump is returning to the White House, what can we expect from the market? Here's researcher Ed Yardini. He tells CNBC that he believes that the rally will continue.
The stock market's roaring because it's anticipating that we're going to get more tax cuts, that we're going to get deregulation, and that those will offset the negatives of some tariffs, clearly, and maybe more government spending. So it's a very fluid situation, but at the end of the day, I think the market's saying that the outlook is pretty good.
All right, so we've been talking about this in the past, by the way, that the market has been at all-time highs. It continues to do so. I guess according to Ed here, things are going to continue going up, right? So is it too late for investors to get in if they've been holding back because they weren't sure where the election was going to go?
Yeah, I'll tell you, we have people that call us and they've been sitting on the sidelines. They had moved a lot of their money to cash, especially back in 2022 when the markets really got hurt and went down considerably, and that spooked a lot of people. So emotionally, they couldn't take the financial pain anymore. And some of these people put most of their money into the money market or fixed income funds. And now the trick is, well, when should you get back in, as you have seen the market only go up since then? Now you sold low and you're buying high. And this is one thing we want people to get away from is emotional investing, because you almost always lose that game. What we want to do and what we implement are strategic investment planning portfolios, because there are ways to have your cake and eat it too. So, for instance, if the market does well, you're positioned to do well in your investment plan strategy. But if the markets go south and they start having some negative results, we have employed and baked into the investment plan strategy what we call our buffers or hedges against the downside of the market. And so a buffer might protect you on the first 15% loss of the market, and you still capture upside if it occurs. And so we can really soften the blow with good strategic investment management just on the investment advisory side. And then on the product side, in the insurance industry, they do have tools that can protect your principal regardless of the market losses, but you can actually earn interest tied to the market indexes and lock those in along the way. And so the investment plan that we design for folks will be personalized, and we really don't know where you should invest your money until we have a plan that is designed and wrapped around what your long-range goals and objectives are going to be. Because once we do that, now I see the solutions and benefits that need to be created and the rate of return you need to achieve to make it all work. So you never have a problem with running out of money or running the risk of derailing your retirement. Because once you have that plan in place, then we can go out to the investment community, the world of product designs, and really put together a customized plan. And this puts people at ease when they go through this process, because they see the value of real planning. And it gets them off the track of making their decisions emotionally, because they just don't know what they don't know, right?
Mm-hmm. Yeah.
And it's what's in your blind spot that hurts you more than anything else. So we get all the fog out of the financial world in working with somebody's financial plan analysis and help them really put together a plan that now they can see in their own numbers how it's designed, how they're invested, why they're invested in certain places to create certain benefits and solutions and tax efficiency. And I think it's a great exercise for people to go through.
You know, David, you and I could sit here and talk about, things that we regret in life. Maybe we didn't go take that job we wanted to. Maybe we regret eating that last piece of cake at the party last night because now we have to run a couple more miles. We could all sit here and think about the regrets of our life. One of them even being, I regret I didn't start planning for retirement earlier. But believe it or not, some people say they regret hiring a financial advisor. What is the deal with that?
Well, I'll tell you, a financial advisor who's trained in comprehensive planning, tax planning, they can see things that you don't see, or identify mistakes that you might be making currently with your financial decisions and how you're handling your monthly cash flow, where you're saving your money, how do you save your money so you have enough when you get to retirement to make it all work. It's like anything else. Say you're not feeling well, you don't self-diagnose maybe an ailment to your heart. You typically are going to go get a checkup. You're going to let the experts who've been trained on doing test and diagnosis procedures that you can't do on yourself or have the tools or technology to do. And then once they see that analysis that they're going to do on you, now they can prescribe first of all, diagnose if in fact there is a problem, and then diagnose a remedy or some type of solution to fix you. Same thing with money. This is a complicated industry. When you look at almost anything that you make a decision on is going to affect your money in one way, shape, or form. So a lot of things that the financial advisor is going to make you think about and address, aside from just saving into your 401k or IRA every year, there are a lot of other financial decisions that a financial advisor should help you in arriving at a good solution for. And when it comes to retirement, there's a lot of different components to your retirement planning. Your Social Security has important decisions. Your pension plan has very important decisions. How you pay and fund your taxes, how you invest your money, how you set up an income plan, your healthcare out-of-pocket costs. How do you solve for that? And that very big expense exposure that could derail your retirement. So a financial advisor that can help you in all these areas should create a tremendous amount of value over and above whatever fees you pay them. And here's what I find most often, and the reason why we get so many calls from people that actually have in their mind advisors working for them that they've been having a long-term relationship over the years with. And what they're finding out is they're not getting answers to a lot of these other things outside of that investment that the advisor might have put them into. Because in this industry, there's different types of advisors. There's product salesmen, where you might be sold investments on the Wall Street side of the industry or the insurance side of the industry. These are product salespeople. They're not financial advisors, even though everybody calls himself a financial advisor or financial planner. Somebody who's licensed to give you tax advice, investment advice, insurance products, if they're a good fit for your planning, and somebody that understands other things outside of that, such as the importance of making good decisions with your Social Security and things such as your estate plan that you really want to integrate with your financial plan. So these are all so many different financial pieces to your overall planning puzzle. And I think it's important when people really work with an advisor, they understand what that advisor can deliver for them and what they can't, so that they're getting the right fit for what they're really trying to solve for their own personal needs. We do comprehensive planning. We're looking for folks that really want help long term, because when you set up a plan, it's not a set up and forget it. It's a plan that keeps evolving through your life, because things will always change. Tax laws change, investment options change, spending goals change, all kinds of things can happen. So if you're looking for a comprehensive advisor relationship and somebody who can create a lot of value so they can assist you in not making costly mistakes that typically are in your blind spot, you don't even see them, then you're just going to get better results throughout your retirement with a higher probability of success and a lot less financial anxiety. And that's what we see. People are under so much financial stress, and we can cut through all that cloudiness because people just don't have clarity as to whether they're doing the right things or not.
Well, if you're looking for some light reading, the U.S. tax code is just over 6,000 pages long. The IRS, their explanations add another 70,000 pages. An opinion piece on the MarketWatch financial website says most of it is not for average folks like, you and me, really. It's for people with great wealth out there. So, however, the article said that there is one thing that we just ordinary folks should grab onto with both hands. That's the IRA to Roth conversion. So, David, when do you do this analysis, and what kind of benefits have you seen with this move?
Well, not everybody should be doing Roth conversions. All depends on everybody's circumstances and particular situation. But we identify a Roth conversion need if, in fact, after we do the comprehensive forecast analysis, if we find that folks are really going to be in a position where their required minimum distributions that would be assessed on their pre-tax retirement accounts are going to force them to take much higher income than they plan to use or need or spend in retirement, because that becomes a growing tax problem over time. We call that the tax torpedo. And when people are in that situation, we're taking a look at first how young they are, and if, in fact, they're going to really need much of that income that we can convert to an IRA, or ideally, they don't really want to touch that for 11 to 15 years, depending on your tax bracket and your rate of return you might be getting along the way. Because here's the thing, when you convert to a Roth, you have to pay the tax on that money in the year you do the conversion. And then you have to give it some time to grow back and overcompensate for the tax you paid on the front end to build up a nice tax-free nest egg over and above the amount you converted plus tax. But here's where I see a lot of people fall victim to. Somebody converts a Roth, they pay the tax today, they invest it back in the market, and all of a sudden they lose money in the market in that Roth. So that break-even point is going to even be much longer, possibly, depending on how the market recovers. So it's got to be a careful evaluation from client to client to determine if the Roth makes sense, because a lot of people are blindly converting monies to a Roth, and they're going to be tapping that money sooner rather than later when they get into retirement. So if they're pretty close to retiring now and they're going to rely on that money for income, it almost makes no sense to convert that portion of the money to a Roth. It's a complicated analysis. I mean, people really have to take a lot of different variables into account before they really make that conversion. But you also have to figure out, when you have to pay the tax, do you have the resources on the Roth conversion to pay the tax outside of your retirement account? And you don't want to use the money inside of your retirement account, especially if you're younger than 59 and a half, because you'll have a 10% early withdrawal penalty for the money you use to pay the tax. So the tax code is very complicated. That's the background that I come from, I work in. And tax planning is so crucial, I think, because taxes are a big erosion factor on wealth. And if we can find a way to reduce taxes, not just defer them like everybody does, but reduce them in the future, then you're going to build more wealth, have more income, and just be more tax efficient. And when you have efficiencies built into your planning, the byproduct is you benefit. Nobody else does. There's no other third party when you're efficient. So it's an analysis that's case by case. But one thing that we use a lot of are Roth conversion alternatives, because there are tools out there that we can create a tax-free bucket of money similar to a Roth, but provide some other benefits that go along with it. And that's an exercise we compare to as well, because there's some opportunities that the wealthy use that a lot of people aren't familiar with that we look at as far as Roth conversion alternatives that can create more value for healthcare benefits and reduce market risk. There's a lot of different things that Roth alternative option can do. And we do a detailed analysis so people can see if they're making these decisions and they're willing to pay the tax today, where you have little pain for possibly big gain later. That's the way I look at it, because you want to stop the compounding of your tax bill when you do these Roth conversions. Because think about your tax-deferred retirement accounts. You're compounding the value along the way, but if you look at the value of your retirement account, that's not all your money. You always have a partner in the game, and your partners are the state and federal government, because they're participating in all your success because you haven't paid them tax yet. And so what we want to do is stop the tax compounding cost by doing the conversion, or if people are able to save into a 401k Roth option or contribute to a Roth IRA, do it today, because you pay the tax on that dollar one time and you let it compound tax-free forever. Now, here's an opportunity. Now that Trump's in office, he's going to likely extend the tax cuts for a longer period of time, because they were set to expire in 2025. So if you're doing Roth conversions, now you're going to be able to do them at a cheaper tax cost with these extension of the tax cuts. And so it makes it a little bit easier to really implement and have a lower tax bill on the conversion along the way.
This is kind of a personal question, Dave, but I've known you for a long time. Are you the kind of guy that uses your turn signals or thinks everyone knows your next move?
I only use it when I have somebody that's either in front of me or behind me, and I'll use the turn signal. But if I'm on a dark country road and I'm at a four-way intersection and there's nobody around me, I don't use it if I'm going to turn. Now, my wife yells at me. I said, well, who am I turning the turn signal on for? There's nobody
no one
around.
there. Exactly. I'm kind of the same way. I mean, if there's somebody around, I'm certainly putting it on. But if no one's there, I'm talking to nobody. So what's the point? Well, there was a recent study done by the Society of Automotive Engineers. They say about 25% of drivers in the U.S. don't signal a turn, and nearly half neglect to use signals when changing lanes. And that, of course, drives TV news anchor Bob Herzog nuts. Listen to this.
That's a turn signal. And when you use it, it's not for you, per se. So if you're worried about it, it's a little too showy. I don't want to seem ostentatious and have these things just blink, blink, blinking and drawing attention to myself. Don't worry. It's not for you. It's for the other people. who are out there with the driving. It's a way to say, hey, I get it. Now, I know there's a lot that we don't agree about in our society, but generally speaking, the use of turn signals to help the other humans is a good thing. So go ahead and use them.
Go ahead and use them. Listen, I'm somebody that says pick your battles. He's obviously really passionate about this. So, to each their own here. But listen, this is a great example to talk about, using your turn signals, being compassionate to those around you, communicating, etc. Just like turn signals help avoid accidents on the road, a well-designed retirement plan helps avoid financial pitfalls. So, David, how do you help clients create a clear retirement roadmap for their future?
Well, I'll tell you, in all the years I've been doing this, I've never seen anybody with a financial plan. And when I ask them if they have one, they say, well, I have a 401k, I have some IRAs. I said, those are tools. That is not a plan, right? So you really have to structure a strategic plan that's designed around your own personal objectives. And, you have to start with your goals, right? When do you want to retire? How much you're going to need to spend in today's dollars, adjusted for inflation and taxes throughout your retirement. There's a lot of variables. How much of a rate of return do your investments need to get before and after or through retirement? What is your tax rate going to be if you don't do anything different throughout your retirement? And longevity. How long do you think you're going to live? So you make sure you have enough along the way. And a lot of times, there's a lot of blanks that we have to fill in for folks, because when we start putting in data, when we do the complementary forecast analysis, there are a lot of things people don't think about. What is the impact on debt if you're going to carry that through retirement if you have debt today? And what can we do today to get you out of debt without changing your lifestyle, but show you a different payoff strategy? Some people want to make some big lifestyle changes when they retire, such as selling a home or a rental property or buying a second home. All these things impact your retirement and your resources. And I just had a couple in the other day, and they're looking to retire in about 2 years, and they're contemplating whether they should sell their home here, buy it down south, keep both homes, rent them out, rent the home here in the off season. So these are all things we work through with different scenarios and various assumptions to see where's the best balance of making these financial decisions, and to what degree can you spend money on a second home if that's one of your objectives, and still make your retirement work successfully. You have to understand your risk. There's all kinds of risk in making financial decisions, right? You have market risk, interest rate risk. There's a lot of moving parts.
For more details or to sit down with David for your complimentary financial GPS, visit masteringyourwealthradio.com.
David Gagnon is an investment advisor representative of Retirement Wealth Advisors, LLC, an SEC-registered investment advisor. First Financial Planners, Retirement Wealth Advisors, and WICC are not affiliated. Exposure to ideas and financial vehicles discussed should not be considered financial advice or a recommendation to buy or sell any financial vehicle. Individuals should consult with a professional specializing in the fields of tax, legal, accounting, or investments regarding the applicability of this information for their situation. Past performance is not a guarantee of future result. Investments will fluctuate, and when redeemed may be worth more or less than when originally invested.